Hello everyone, it's Thursday and you're watching Within the Frame. I'm Kim Bo-kyung. The Bank of Korea kept its benchmark rate unchanged at 3.5% today, holding the policy rate for the fifth consecutive time. And one of the reasons behind such a decision is because consumer prices have remained in the 2% range for 2 months in a row. And China's default risks from its real estate market are said to be one of the reasons behind that as well. However, inflationary pressure due to rising global oil prices and growing household debt in the country are some of the factors BOK might have to consider when making its next rate decision. How are experts seeing the current economic situation and what might affect the next rate setting? For this, we invite Professor Kim Yong-jin from Sogang Business School. Professor Yong-jin, welcome to the show.
Good evening.
Good evening. And we also have Professor Sei-wan from Ewha Womans University. Good to see you, Professor Sei-wan.
Thank you for having me today.
Thank you for being with us. Now, first question to our Professor Yong-jin. So, containing inflation was the biggest concern when deciding rate. And South Korea's consumer price growth slowed for the 6th straight month last month to the lowest level in 25 months. However, some say it could rebound due to rising oil prices. How do you see this?
Well, as you mentioned, South Korea's consumer price recorded the lowest level in 25 months after it fell below 3% for the first time in June since September 2021. It looks, being stabilized at the moment. According to the data from Statistics Korea, consumer price rose 2.3% in July from a year earlier. Compared with a 2.7% in July. Basically, the decrease in consumer prices is very meaningful because it happened while the prices of utility services, including electricity, continue to go up sharply by 21.1% over the period. The limited rise in the consumer price was contributed by decreasing prices of agricultural and fishery product. Core inflation, which exclude food and energy prices, also went down to 3.3% on year in July from a 3.5% increase in June. However, like you mentioned, we have to be very cautious when making conclusion because recently, crude oil prices, gas prices, and also grain prices tend to go up.
Right, I see. So it does seem stabilized for now, but we'd have to see for how it goes. Now, Professor Sei-wan, another reason for the BOK's rate freeze is concerns over China's economy. Chinese property giant Evergrande Group filed for bankruptcy in the U.S. recently, and another major player, Country Garden, is struggling with debt problems as well. Now, first of all, could you explain to us what problems China's property market is seeing right now?
For the last 2 decades, booming real estate market has been the engine of Chinese economic growth. Even China became the second largest economy in the world. Chinese economic growth depends much on the real estate market, which covers about a quarter of total GDP. This real estate market leading Chinese economic growth model adopted by Beijing is not working now. Like before, as real estate market is cooling down quickly from 2 years ago due to excess supply of the apartment, COVID pandemic, and so on. Major real estate developers like Evergrande and Country Garden are under financial stress because new apartment built are not well sold recently. Under slowing Chinese economy today, real estate market crackdown can spread out to other sectors of economy like commercial banks and construction.
Right, I see. Now, Professor Sei-wan, we are going to talk about whether China's 40-year boom is over or not. But before that, amid such a worsening economic woes, the People's Bank of China on Monday lowered its one-year loan prime rate by 10 basis points to 3.45%. However, the five-year rate, the peg for most mortgages, was left unchanged. And experts say China is being quite prudent. Why is this?
Actually, People's Bank of China's interest rate cut on Monday by 10 basis points was smaller than market's expectation. Also, market expected that five-year loan prime rate, which is a base rate for mortgage loan, would be also cut by 10 basis points, along with one-year prime loan rate. But People's Bank of China left five-year rate unchanged. This asymmetric interest rate cut means that People's Bank of China is under a very difficult situation over different policy targets. Under slowing Chinese economy, People's Bank of China should have lowered interest rate more than 10 basis points, but depreciating Chinese yuan was another serious factor if they cut the rate. When yuan depreciates further under difficult Chinese economic situation now, it is going to be a shock to Chinese financial market and economy because foreign investors is more likely to withdraw money from Chinese market. Actually, Chinese yuan is the most depreciated among all Asian currencies this year by more than 6%.
Right, I see. So the reason behind China's such decision was because they were worried about yuan depreciation. I got it. Now, Professor Yong-jin, now regarding the impact such an event could have on South Korea's economy, as China accounts for a large portion of South Korea's exports, experts say such a crisis might slow down exports to China and even hinder the economic recovery. How do you see this?
Well, absolutely, the Chinese situation may cause a lot of trouble to Korea. China, has suffered lack of liquidity, which causes a lot of troubles to Chinese economy, such as hampered economic growth, sluggish recovery of consumption and investment, collapse of real estate property price, thus, default of property developers, and also high unemployment rate. This kind of economic downturn of China influences Korean export a lot. A low consumer demand, as shown in Chinese CPI of almost -4%, affect the demand for Korean consumer product as well as part and materials. Weak investment also affect the demand for Korean machines and tools as factories do not produce much. With regard to the decrease of Korean export to China, the more important thing is that competitive economic position between Korea and China has been changed. Before 2020, Korea had competitive advantage over China across technology level from low-tech to high-tech. But since 2020, China has competitive advantage in low-tech and high-tech. This is why South Korea experiencing trade deficit of 17.3 billion US dollars. That to China from October 2022 to August 2023. This huge trade deficit is one of the most important reason Bank of Korea cannot raise the base rate of interest easily.
Right, I see. Professor Yong-jin, that being said, so it seems like South Korea is no longer seeing advantages over exports to China. That being said, Professor, I'd like to ask you, what should be done for us to enhance exports to China?
Well, that's very tough questions. Now, even this year, our government cut the R&D expenditures in its budget. The only way we can keep the competitive advantage over China would be like increasing cost efficiency and put more R&Ds in a more creative, product. And also, we have like the natural resource-based, manufacturing, and some of very specialized machines and tools, and also like sensors. So we have to put more the R&D money in those kind of things, and also try to promote more digital transformation to gain cost efficiency over China.
Right, I see. Well, Professor Sei-wan, before we move on to the U.S. economy, let's talk about the issue that you have brought up earlier. The Wall Street Journal pointed out that the economic model that carried China from poverty to great power status seems broken, and that its 40-year boom is over. Now, what's your view on this, and how might this affect the South Korean economy overall?
For the last 20 years, we saw that Chinese economy is growing so rapidly, which is unprecedented in Chinese history. And there is no question that Korea is one of the largest beneficiaries of Chinese rise. But without structural reform related to real estate market and public corporations, that it will be very difficult for China to recover previous rapid economic growth. Korean economy is actually highly intertwined with Chinese economy today. China covers 25% of Korean total trade, and Korean's won value is highly related to Chinese yuan. Korean economy is slowing down this year thanks to decreasing export to China, particularly in memory chips. This year's Korean economic growth is expected to be below 1.4%, mainly due to slowing China. When Chinese economy slows down from real estate market downturn, it will be difficult for Korean economy to recover by the end of this year.
Right, I see. Now, Professor Yong-jin, let's now talk about the economy in the U.S. The Fed has pushed the U.S. benchmark interest rate to the highest level in 22 years. Now, how is the U.S. economy doing since then?
Well, probably everybody knows, the U.S. inflation rate reached, its lowest point since, early 2021. In just 1 year, inflation in the U.S. has fallen from a peak of about 9% to just 3% due to decreasing prices of gasoline, airfares, used cars, and groceries. And so financial markets and economies are now talking about what is called immaculate disinflation, or a soft landing of lower inflation without recession. Even further, they argue that we need to rethink of the economic theory, which predict price decline comes with big pain, such as huge unemployment. Seems like this theory does not quite right at the moment. But the U.S. labor market is still very strong. Economy is very solid. So the belief of the soft landing of the U.S. economy is evidenced by long-term interest rate of Treasury bond, which went up to 4.3%.
Right. It's interesting to see how the soft landing scenario is folding out. Professor Sei-wan, given all those indices, Fed Chief Jerome Powell is expected to speak at the upcoming Jackson Hole meeting that will be held between August 24th to 26th. Now, what will Powell and the Fed be taking into consideration ahead of the next FOMC meeting?
Well, I wish I had a right answer to your question. The next FOMC meeting of U.S. Fed is on September 19th, and many things will be unchanged, changed until late September. In retrospect, as Professor Kim pointed out, U.S. inflation is pretty much stabilized recently down to 3% level from previous 9% level last year. It means that U.S. Fed's straight interest rate hikes from 0% to 5.5% in a single year was successful in terms of stabilizing inflation. But U.S. Fed is officially saying that the inflation pressure is not yet fully controlled due to higher housing rents and service prices. So if I give my best guess as of now, U.S. Fed will leave its key interest rate at current level of 5.5% in September FOMC meeting because they want to put a balance between inflation control and rising global economic instability.
Right. We'll have to wait and see what kind of decision Fed will make because we have some time till the next FOMC meeting. But Professor Yong-jin, the BOK maintained its key benchmark rate, meaning that the rate gap between South Korea and the U.S. will either stay at its current all-time high or widen even more. Is this okay?
No, I don't think, they'll be okay. When considering recent trade deficit and devaluation of Korean won, upward pressure for the foreign exchange rate, between U.S. and Korean won, due to the trade deficit and the huge amount of household debt, BOK may not have the power to increase or the base interest rate, but it will be reflected on the exchange rate. If the exchange rate goes up, it will give upward pressure to consumer and production price, which in turn causes another round of inflation to Korean economy, even though it may help the competitive advantage for exporters. But even these exporters in Korea who have to import large part of the materials would suffer high raw material prices, which will affect, again, their bottom line badly in the long term. Moreover, the widened gap in the interest rate between the U.S. and Korea will cause, foreign investors to run away from Korean capital market in the future.
Right, I see. Well, we are going to talk about the $1 exchange rate, but before that, though BOK held the rate at 3.5%, Professor Sei-wan, central bank might be concerned over growing household debt as more people are taking out loans to buy apartments before prices rise again. How is BOK seeing this?
Domestic household debt began to pick up from April this year as housing demand increases. And it should be noted that household debt is a major factor for Bank of Korea's key interest rate decision. Actually, uncontrollable household debt increase for the last 5 years was controlled due to several interest rate hikes by Bank of Korea. But it would be difficult for Bank of Korea to raise interest rate for controlling household debt increase this time, because the apartment demands and mortgage loans are generated by young people who are not speculators in apartment, but real demanders. Also, it became extremely important to provide apartment to young generation for raising birth rate and marriage rate for avoiding population decrease in the long run. So if household debt is not increasing fast, household debt is not much considered in the next interest rate decision by Bank of Korea.
Right, I see. Now, Professor Yong-jin, coming back to the $1 exchange rate. So the weakening of the Korean won against the U.S. is raising questions over whether the BOK should consider resuming rate hikes, right? What is leading the latest volatility in the $1 exchange rate, and how will this affect future BOK rate decisions?
Well, there are lots of factors which affect the exchange rate, especially Korean economy. Both, all the countries' currency in East Asia, like Korea, China, and Japan, their currencies are very weakened recently compared to the U.S. dollars. So basically, economic situation in the U.S. is very strong, and Chinese economic situation is very bad. Korean export, dwindled. So these are all, causes, which pressure the upward pressure onto Korean won. But, as I mentioned earlier, keeping the benchmark rate same is not always good for Korean economy because the effect of it would be reflected on the exchange rate. Investors may think, U.S. Treasury bond, as a favorite option instead of a Korean stock or bond, and which will cause the huge outflow of foreign currency, in particular in the U.S. dollars. Or the prices of imported goods and materials would increase dramatically to worsen the people's everyday life due to high prices and bad bottom line of exporters. Even further, the Chinese economy is experiencing deflation at the moment, like I mentioned, which affect Korean economy in various ways, including, declining export, to reduce the local production sales, declining investment from China, etc. So the BOK has to rethink of raising the base interest rate in the future, sooner or later, to balance out the negative effect of the gap and the interest rate, even though the domestic lenders may suffer.
Right, I see. Maintaining the key interest rate could not always be a solution. Interesting. Now, Professor Sei-wan, due to many uncertainties that we have talked about, many say it will be hard for the BOK to start cutting rates this year. But what are the chances of a pivot next year, and what conditions would be necessary for that?
Actually, Bo-kyung, that is the most asked question by the Federal Reserve Chairman Jerome Powell. Then he answers like, that depends on data. So whether Bank of Korea will decrease the key interest rate downside absolutely depends on the path of inflation and economic growth for this year and next year. Domestic inflation is pretty much stabilized at only 2% level recently. But there are some uncertainties on inflation, like higher oil price and higher agricultural products price. At the same time, the growth of Korean economy is limited due to the Chinese economic turmoils and continuing war in Ukraine. And it should be pointed out that as time goes by, economic growth and employment will be more important than inflation in difficult situation of Korean economy. So to summarize, Bank of Korea will try to find a chance to cut the rate only next year under the condition that inflation is stabilized.
Right, I see your point. Well, I'd like to ask many more questions to our economic experts, but unfortunately, this is all the time we have for today's edition. Thank you, Professor Sei-wan and Professor Yong-jin, for your time and insights. We really appreciate it.
Thank you very much.
Thanks for having me.
Thank you. All right, that's all for Within the Frame tonight. We'll be back tomorrow with more in-depth stories. Thank you for watching, and goodbye.